Okay, chapter 5. Now we at least get to go back to a little bit more of thinking as opposed to reading detail. Getting involved in the bigger picture. Because we're going to talk about what is income. That'll be the first thing we talk about. Our learning objectives for this chapter are understanding that there is, and we've touched upon this, so we'll repeat it. There's a concept of we don't pay tax until it's realized and recognized. You have to realize it and then you recognize it. You have to actually sell the stock. You actually have to make the income. You have to receive it. Remember the doctrine of constructive receipt? If you didn't get it, it's still not income to you. Yes, it's owed to you, but if you didn't get it, it's not receipt yet. It's not realization. What are the various sources of income, and apply basic income exclusion principles. So let's see what we got. Gross income. I think we can make this a little bigger here. Gross income. Yes?
So the income for individuals is different from the businesses because of the gap. It says you recognize revenue when you earn it.
So there's, okay, so the question is the income for individuals different than for businesses? And the answer is, for businesses, which could be individuals as sole proprietorships, the answer is that you as an individual, on everything that is not a business, is on a cash basis. You know what cash basis is from your accounting. Everything you do on a business sense could be cash basis, but rules may dictate that you have to be accrual basis. Income tax law learned from the accountants that one of the greatest gifts that accountants gave was the concept of accrual accounting. That's a great gift because it shows that in order to really measure what a business made, accrual accounting trumps the day. And I don't mean Donald Trump. I mean trumps the day is the best way. So tax law said, well, if that's true, then we should not ignore that accrual accounting is the best way to measure income for a business. And indeed, that's what tax law does. It dictates that in many circumstances, you must use, for business purposes, accrual accounting. For the moment, until we get to those chapters, we're cash basis. The question we have now, really, is what is income? Let's take a little discussion break for a second. Suppose you do the following. You buy a piano, and this is an actual tax court case. I'm not mixing up the facts, I'm just making up the exact facts, but there is a tax court case like this. You buy a piano, it costs you $500. It's a used piano. You get the movers to bring it to your house, and like the treadmill that people buy. The first week you tinker around with the keys. First week people get on the treadmill, and then the treadmill becomes a clothes hanger. And so the first week you fool around with the keys of the piano, and then after that it becomes a place to put pictures and books. A few years go by, and you suddenly get the urge to play again. So you go to sit down to play it, and it's out of tune, and you call a piano tuner to come tune the piano. They open up the piano to start working with it, and the piano tuner says, oh, no wonder it didn't sound right. I just found a wad of $500 bills here. It adds up to $4,500. Did you know you left it here? That's what he says to you. Did you know you left $4,500 in this piano? And you, of course, you're going to say, of course, it's mine. Give it to me. Right? Fast. You'll say it real fast. That money was in the piano when you bought it. You didn't know that. This is 4 years later. Do you have to pay tax on that? Is that income to you? You didn't go out and earn it. You just found it. Is that income? Let's have a discussion. What do you think? Anybody?
It's a gift.
It's a gift. From whom? From the person who sold you the piano, right? Sounds like a gift. What other opinions we have?
It's a gain.
You think it's a gain. Is that a taxable gain?
No, I don't know.
Don't know? Don't think so. Okay. Cedric, what would you do with it? You missed it. You should buy that piano. It's got $4,500 in it that the seller didn't know was there. You find it. Is that income to you? Is it taxable? You don't think so? How many people, other opinions? Yes, Marcella.
Technically, it is taxable, but since they don't know about it, I don't know if the person's not going to tell the government, hey, I just found $4,500.
So Marcella's saying technically it is taxable, but who's going to report it? You agree with that? How many people think it's taxable, first of all? How many people think it's not taxable? All right. Robert, on what theory is it not taxable? Why do you think that?
Well, I also saw it as a gift, actually. Like, I consider it to be a gift.
You think it's a gift. Okay. And that's a good answer. But it turns out that it's not a gift, and we can say it's not a gift. First of all, we don't know if it's income yet, but we will say it's not a gift, because a gift has to be given gratuitously. Has to be given with someone's intent to give it to you. The person who sold you the piano didn't intend, as far as we know, to give you that $4,500. They forgot about it. By the way, we're not discussing the moral issue of whether you should return it to the seller or not. That's not for this class. I'm not ethical, you understand? That's the way it goes here. Tax accountants are not ethical. But we're not discussing that. But we want to know, is it taxable income? So now we know it's not a gift under the gift tax law because it's not gratuitous. But now we have to know if it's income. So it turns out, as we'll see in a minute, that it is income. It is income. But Marcella's got an interesting point, which is another discussion in your ethics class, is who's going to report it? Nobody. Maybe for $4,500 you wouldn't think that you could get caught. Maybe. What if it was $450,000?
They just use a little cash and
Oh.
into your account.
Okay.
Let me just go to the bank. Oh, I'm about to put $400,000. Like, where did you get it? You know?
I love you, Rama. Love you. The only thing is, I'm going to report you to Steve Loeb, so when he's going to make sure to get you for ethics. Yes.
So, would they be able to do that if you put a certain amount in your bank account? Can they say that's income? Because, like me, I write my sister a check so she can pay rent. So that's not her income. That's just.
That's a gift. Unless she's going to owe you the money. Is she going to owe you the money back?
Well, no, I'm just paying my share.
Oh, and she pays you your share?
No, like she just pays it, but I just gave her my part.
Okay. So,
Would they be able to tell her, like, oh, you have to pay tax on what she gave you?
no, clearly that's just an exchange. That's just an exchange. It's not income, clearly. But where were we? We were with the cash. Cash is a problem when you go to put it in the bank. There are strict banking rules. I might as well tell you this now so that you don't make a mistake and get caught for money laundering, or at least accused of money laundering. Do not put more than $8,000. Why? You say the rule is $10,000, and you're right. But why 8? Because the banks have a responsibility to do the following, and that is look for patterns. And the way they look for patterns is they target $8,000 cash in or out of accounts, and they'll add it to the list. And if they see a pattern, then they'll report you, even though you never do a $10,000 amount. What's a pattern? Do 8,000 one week, 8,000 the next week, and you just keep on doing it. Sooner or later, the feds are going to show up at your door. It is extremely tight to get cash back into the market if your cash, even if your cash is after tax dollars and legitimately reported. It's extremely hard to get that in without having the feds show up at your door. You got to do it slowly, in small increments. I don't know why I'm telling you this. This is terrible. Maybe I don't want you implicating me as aiding and abetting your illegal activities. Maybe that's what it is. All right. So if you find a certain amount of money, I think Marcella's right, and I think Nikem's right, that if you find $4,500, chances are the IRS is not going to recognize that. But here's the law. Let's take a look what the law says. The code says the following. This is Section 61A. Get to know and love Section 61A. Income, or gross income, is income from all, well, actually, it's not what it says. It says it means all income from whatever source derived. That's the key phrase. All income from whatever source derived. So you can find it in a piano. If it's not a gift, which it isn't because it wasn't gratuitous, it's income. You can find it on the street. You could win the lottery. You didn't do anything for it. You bought a ticket, but that's all you did. It's income from whatever source derived. That's the law. The way our law works is the following. Section 162 comes along and says that you're allowed to reduce gross income for the cost of that income. That's the net principle. Remember we talked about the net principle? We only get taxed on the net. And then there's other deductions that are allowed as well. So we wind up being able to reduce our gross income by what it costs us to produce the gross income. That's the good news. The other good news is that the code, and I think the slide will say this in a minute, the code then says certain things are not taxable. Certain income is not taxable. You already know at least one, we've drilled at home, municipal bond interest is not taxable. So the overall riding result of our tax code is the following. And this is the way I want you to be able to say it, because there'll probably be a short answer question on the next quiz around this topic, which will the answer will be something similar to, okay, yes, our tax code works the following way. Income is from whatever source derived and is taxable unless there is a specific code section that says it's not taxable. Say that one more time. Income is taxable from whatever source derived according to the way our law works, except if there is a specific statute that says it's not taxable. So now you get to know the next group of bad news. You thought the bad news was learning how to determine filing status and whether someone's a dependent or not, because there's a lot of detail. Now your job is to know what are the exceptions to the general principle that everything is taxable. So the good news, again, is secondary sources give you checklists. I'll try to remember to do this. Someone send me an email to remind me to do this. I'll try to take a picture from Custom Clearinghouse's Master Tax Guide. They have in there a wonderful set of pages. They might be 20 pages in length. And the pages go through various types of income. And in one group, it'll say, this income's taxable. And in another group, it'll tell you what's not taxable. Now, the truth is, the group that says what's taxable is really a misnomer, and it's not correct to say it that way, because everything's taxable unless it's excluded. But the more important list to look at is their list that says what's excluded from taxation, what isn't taxable. Real powerful couple of pages. I got to know it very, very well in my early tax career, so that after a while it became second nature to me to know what's not taxable. So try to remember to send me an email, and I'll send that to you. All right. Taxpayers recognize gross income when they receive an economic benefit. They realize it, and the tax law does not provide for an exclusion. That's another way of saying the same thing. You receive an economic benefit. You're better off for it. You find $4,500 on a piano, you're better off for it. When you find it, you've realized it. And it's not excluded. There's no exclusion for you find money, it's not taxable. Otherwise, with my employer, I would work it out that suddenly I found money that they owe me as a salary. They didn't pay it, I found it. Leave it in my desk drawer, I would tell them. Can't do that. What's it mean, economic benefit? This answers your question, Marcella, about you and your sister's situation. It's like borrowed funds. She paid for you, so you borrowed from her, now you're paying her back. That's like when she pays the rent for you, it's like she's lending you the money for the rent, and then you pay her back, or however it works. You follow what I'm saying? So if you borrow money from somebody, you owe it back. You don't have an economic benefit, you have to pay that back. Your balance sheet shows a liability when you borrow money. Realization principle. You have to realize it and recognize it is the bottom one. We'll get into more detail what the realization and recognition means further on. Right now, we'll just leave it at a basic idea. Realization means that there's been a change in property rights. The money used to belong to the employer. Now they paid it to you. It belongs to you. You've recognized it unless it's otherwise excluded by tax law. You know what I want to do? I want to do one thing. Because we're going to get to it later on, but I want to draw it home right now. Because then when we get to it, we can just brush over it. Here, this is like really important. And it's really cool. And it's cool to learn that now. Because we just talked about borrow money. It's not income. Here's another class discussion question. You borrow money from your parents. Well, better yet, you borrow money from your employer. You borrow money from your employer. Let's do that example. $10,000. You're supposed to pay it back. And you make some payments back. You're down to $8,000. One day your employer comes into you and says, you know what? You did a good job of paying off $2,000. Took you a year. You're a hard-working employee. Forget the rest. Forget it. Now, when you borrowed the $10,000 from your employer, was that income? No, you're right. It wasn't. Now you've been forgiven the debt. That's what's happened. The debt has been canceled. You don't owe the money anymore. What do you think about that?
Now since you don't need to pay it back, is that $8,000 taxable?
That's my question. What do you think? Is it taxable?
Probably.
Why? You got an economic benefit. You did indeed. When the loan was made or when the loan was canceled? It was when it was canceled. Let me tell you something. You'll be a real powerful, question?
So that would count as a gift then?
Great question. Can an employer make a gift to an employee?
Yeah.
Gift has to be by definition out of the goodness of their heart, gratuitous. Is an employer's gift to an employee, quote unquote, ever gratuitous? It would be a bonus. Is that taxable? Bonuses are taxable. It's very difficult for an employer to make a gift to an employee and say it's a gift. If I make a gift to an employee of mine, which I would never do, I'm a mean boss. If I did it, is it because they did a good job? Or is it because I just happen to like the way they live their personal life? It's performance. It's even if in the back of my mind, I think it's a gift because I like them. Why do I like them? Why do I like them? They're not relatives of mine. They're employees. They're doing a good job. So employer-to-employee relationship is most likely going to be income, no matter how you classify it. And now you've learned with this economic benefit principle with the loan, the cancellation of the debt, let me tell you something. You've learned a very powerful lesson here. One that if you take with you through the rest of this course, you'll see it over and over again. But if you take it with you and you really drill it home in your mind, you'll be a well-advanced, better accountant than most out there. And that is anytime there's cancellation of debt, you got to look to see whether it's taxable. There are exceptions, but the general rule will be cancellation of debt is an economic benefit, hence taxable. Very powerful. Many accountants, I've seen it happen over and over again, forget it, don't realize it, don't even know about it. They just forget that there is such an idea. All they know is the loan went away. They don't think of it as income, but it surely is unless there's an exception to it. Okay, I think we're going to stop here and we're going to play a little Kahoot game. So that's where we'll hold here.